Everyone can agree that to maximize your returns over the long run, stocks are the way to go. Increase your equities holdings, and you increase your chances of higher returns. But when it comes to money that we don't want to put in stocks, our in-between money we might want to access for a home down payment or other major purchases, many of us get stuck. And more specifically, the decision between holding our money in cash or putting it in bonds. And let's be honest, for those of you who've been monitoring the bond market the past several years, it hasn't exactly been inspiring confidence. Bonds got hammered in 2022 when interest rates spiked, and many people watched their safe bond funds lose 10, 15, even 20%, while their high-yield savings accounts were suddenly paying 4 or 5%, which throws the whole decision between cash or bonds into even a bigger confusion. So to help you work through this debate, let me share with you a simple, 3-step framework to help you make this decision. Additionally, I'll give you my specific recommendations for both cash and bond options, so you won't have to think about this, hopefully, again. Alright, with that, let's jump right in. But first, let's start with the fundamental framework that drives everything. The investment risk spectrum, the foundation of every smart portfolio. For this spectrum, we're going to plot our stocks, bonds, and cash on a simple risk versus return chart. On the far top right, we have stocks, the asset with the highest risk, but also with the potential for highest returns. The stocks are most portfolios' growth engine. They can be quite volatile, but historical data shows that stocks have returned about 9 to 10% annually the past 100 years. Excellent returns for those who want to grow their wealth. In the middle, we have bonds, assets that have medium risk but also medium returns. In the world of portfolio design, these are often described as stability anchors. When we add more bonds to our portfolio, we might have less overall returns. Historically, they have delivered between 4 to 6% annually, but our ride is a lot smoother because they're not as volatile as stocks. And finally, at the bottom left, we have cash, the asset with the lowest risk but also the lowest returns. For most people, this is their safety net. Historically, cash has averaged around 3% annually. And I also like to clarify what I mean when I'm talking about cash here. I'm not just talking about literal cash in your wallet, though they do count. Cash includes checking accounts, high-yield savings accounts, money market accounts, money market funds, and even treasury bills. And the common characteristic with cash is that they're highly liquid, meaning you can access them quickly, usually within days, and they have virtually no principal risk, meaning you won't lose your initial investment. They're either FDIC insured up to $250,000 or backed by the government. The downside is that rates you earn on cash is quite minimal compared to other assets. Now, what do I mean when I talk about bonds? The simplest way to think about bonds is to think of them as IOUs, the money you lend out. You have treasury bonds and notes, which are government IOUs lasting 2 to 30 years. Corporate bonds are company IOUs. Municipal bonds are state and local government IOUs. And bond funds are professionally managed collection of these bonds. The common characteristics of bonds are that they provide fixed or predictable income, the principal can fluctuate before maturity, they're generally safer than stocks but riskier than cash, and they have duration risk, meaning prices fall when interest rate rises. And here's where most people get stuck. When it comes to our in-between money, our short-term to medium-term money, or money we just don't feel comfortable losing value in, many of us have a hard time deciding between cash or bonds. And here's why this decision has become so much harder in recent years. Back in 2019, this wasn't even much of a debate. High-yield savings accounts were paying 1.5 to 2%, while broad bond market index funds were yielding around 2.8 to 3.2%. The choice was obvious. If you had money sitting around for more than a couple of years, bonds were the clear winner. But then everything changed. The Federal Reserve slashed interest rates to near zero during the pandemic, and when the inflation spiked, they had to aggressively raise rates from 0.25% in early 2022 to over 5% by mid-2023. This created a perfect storm that flipped the traditional relationship on its head. Thus today, high-yielding savings accounts are offering around 4%. Meanwhile, if you bought a broad bond market index fund at the beginning of 2022, you would have lost about 13% that year as interest rates spiked. So most people are looking at this and thinking, wait, I can get 4% in a completely safe FDIC insured savings account, or I can put my money in bonds that might lose in value? It seems like a no-brainer, right? However, it's not that simple. Those high cash rates you're seeing today, we're not sure how long they'll stay this attractive. Based on basic economics, the moment the Fed starts cutting rates, which many economists expect over the next 12 to 24 months, those nice 4 to 5% savings account rates will likely drop as well. Meanwhile, bond funds are positioned to potentially benefit when rates fall. When interest rate drops, existing bond becomes more valuable because they're paying higher rates than new bonds being issued. Now, you might be thinking, what if interest rates don't drop? What if they stay elevated or even go higher? In that scenario, your cash will continue earning those attractive rates while bond prices might continue to struggle. But the truth is none of us know. And that is exactly why this decision is so hard. That is if you're looking at short term and you're trying to chase after today's highest interest rate. Because when we wind the history clock back, this dilemma has come up several times. In the early 1980s, interest rates skyrocketed to combat inflation. The Federal Reserve pushed rates as high as 20% in 1980, and even simple CDs were paying over 11% annually. People are asking, why would I buy 30-year bonds at 12% when I can get 15% in a money market account? In 1994, when Federal Reserve raised interest rates 6 times for a total of 2.5 percentage points, the same debate emerged. Cash suddenly became very attractive. However, in both of those cases, many investors who abandoned bonds also missed out when rates eventually came back down. I know what you're thinking. Tay, I didn't come here for a bond history lesson. Get to the point. And yes, you're absolutely right. Trust me, I did not wake up this morning thinking, hey, I want to also bore everyone with interest rate history from the 1980s. However, we also have to understand that history matters because it shows us that this confusion is normal and cyclical. And more importantly, we have to look and understand the broader picture if we want to make wise, rational decisions when it comes to our money. The last thing we want to do is make emotional decisions based on short term, and worse, on predictions about future interest rates. Because let's be honest, even the Fed doesn't know what the future interest rate is going to be. So what we want to do is focus on what we can control: our timeline, our risk tolerance, and our specific goals. And more importantly, recognize that no matter how hard we try, there are just things we cannot fully control in life. Alright, with that, let's dive into the framework. The 3-step decision framework. The first step is to determine your time horizon and purpose. This is the foundation of your decision. If you're choosing not to put money into a stock market because you might want to access it soon, you want to identify what that timeline will look like. Additionally, you also want to identify specifically what the purpose is. Because here's the thing, not all money with the same timeline should be treated the same way. For example, let's say you have $50,000 that you might need in 3 years. To make the right decision, the purpose matters a lot. If it's for a house down payment where you absolutely must have that money available on a specific date, that's very different from money you're setting aside for a potential business opportunity where you have a lot more flexibility on timing. The more rigid your timeline, the more you should lean towards cash. The more flexible your purpose, the more room you have to consider bonds. This is not about maximizing returns, it's about matching your money to your actual life plan. So before we go any further, I want you to write down exactly when you need this money and what for, because that foundation will drive everything else in this framework. The second step is determine your risk capacity as well as your risk tolerance. Now, a lot of people confuse these two, risk capacity and risk tolerance. So let me break this down for you. Risk capacity is about your actual financial situation. How much risk can you afford to take? This is the objective mathematical side of the equation. Ask yourself, how stable is your income? Do you have other sources of funds if this money loses value? Would a 10% temporary loss affect your ability to meet your goal? How much time do you have to recover from potential losses? For example, if you're in a stable profession with stable income, and the money you're debating over represents only a small portion of your total net worth, you have high risk capacity. But if you're a freelancer with irregular income, and this is your only safety net, your risk capacity is much lower. Risk tolerance, on the other hand, is about your emotions. How much risk can you psychologically handle? And this is quite personal based on each individual. How would you sleep if your money lost 5% in a month? Would you panic and sell if bonds drop by 10%? Do you prefer the certainty of FDIC insurance over slightly higher returns? Have you lived through uncertain times before and know how you would actually react? Some people prefer FDIC insurance to slightly higher bond returns, whereas others are comfortable with some volatility for potentially better long-term outcomes. Neither approach is wrong. It's about knowing yourself and being honest about how you'll actually behave when markets get bumpy. Here's a key insight from this step. You need both your capacity and tolerance to align. You might have the financial capacity to take risk, stable job, plenty of other savings, but if you lose sleep over 5% dip, that's a valuable information about your risk tolerance. Understand that your peace of mind has real value. The sweet spot is where your situation and your emotions both point in the same direction. If you have a high risk capacity but low risk tolerance, lean towards cash. If you have both high capacity and high tolerance, you have more room for bonds. Now, if you're working through steps 1 and 2 and realize just how many variables go into this cash versus bond decision, your timeline, risk capacity, risk tolerance, interest rate, you might be feeling a little bit overwhelmed. And honestly, that is completely normal. This is one of those financial decisions that seem simple on surface, but could get complicated fast when you dig into your specific situation. Should that house down payment money go into bonds if you have timeline flexibility? How do you actually measure your risk tolerance versus your risk capacity? What if your situation doesn't fit neatly into a category? And that is exactly why I created the Financial Tortoise community. Within the community, you'll get access to a Financial Tortoise system that will not only help you simplify, but systematize and streamline your finances for success. Let me tell you about a member. Let's call him Michael. who came to our community completely paralyzed about this cash versus bond decision. He'd been reading conflicting advice online for months, constantly second-guessing himself, and losing sleep over whether he was making the right choice. During our one-on-one coaching session, we walked through this exact framework together, and he was able to develop a clear cash versus bond versus stock allocation for his money. An allocation that he understood and one that worked for him. But here was what really changed for Michael. He finally had the confidence in his decision because he was able to go from analysis paralysis to financial clarity. He was able to make an informed decision rather than following what some financial institution told him he should do. That's the real transformation that happens in the financial tortoise community. You can break through your analysis paralysis and start living with confidence in your financial decisions. The financial tortoise system leverages not only the power of education through specially curated video courses, but it provides you the tools as well as accountability to help you to the finish line. However, to maintain the quality of support each member receives, I only open enrollment a few times a year. So join the waitlist today at financialtortoise.com/community and get priority access when doors open again. Many members have completely transformed their financial lives, and with the right guidance and clear plan, you can too. You deserve it. I would love to see you inside. Alright, with that said, let's get back to the video. Alright, step 3. Now here's where we stop overthinking and start making some decisions. Based on what you identified in steps 1 and 2, we're going to create a simple allocation they can actually live with. But first, let me clarify what we're actually deciding between here. This framework assumes you've already allocated your truly long-term money you won't touch for 10 plus years, into stocks for maximum growth. What we're deciding today is what to do with your in-between money. The money that's too short-term for stocks, but too long-term just to sit in a basic checking account. So let's use what I like to call the simple allocation framework approach for this in-between money. First, establish your baseline. Any money you need under 3 years, keep it in the form of cash. This will include your emergency fund, for most people, which will be anywhere between 6 to 12 months, as well as money for upcoming short-term goals. House down payments, wedding funds, or education tuition. High-yield savings accounts are a good option here. If you have a fixed date when you'll need the money, CDs could also be another option. Just know that under 3 years, there's most often not enough time for bonds to recover if they have a bad year. Second, for money you need in 3 to 5 years, here's where steps 1 and 2 starts to matter. If you have a rigid timeline like a specific house closing date, lean heavily towards cash. If you have flexibility in timing and high risk tolerance, you might consider putting a portion in bonds. But data shows this is still a toss-up time frame. Over a rolling 3-year period since 1976, bonds have outperformed cash only about 65% of the time. Over rolling 5-year periods, bonds have outperformed cash 82% of the time. So you'll have to decide. Third, for money you won't need for 5 to 10 years, this is where bonds could make the most sense. That is if you want to have some money in bonds. As mentioned earlier, over a rolling 5-year period since 1976, bonds have outperformed cash 82% of the time. But over a 7-year period, it jumps to 89%. And over 10-year periods, that success rate climbs to 94%. If you have low risk tolerance, you might still keep some in cash, but this is where bonds can provide meaningfully better returns than cash while still being much safer than stocks. But I've also seen people who skip bonds altogether because they have a high risk capacity as well as risk tolerance and jump straight to stocks for medium-term money. But that is a personal decision. And I also want to remind you a couple things regarding the allocation here. One is that please remember we're not talking about your retirement accounts or money you're investing for decades. This framework of cash versus bonds is specifically for that middle ground. Money that you feel is too important to risk in stocks, but too valuable to let inflation slowly eat away at it. 2. Also remember that the goal isn't to optimize every last basis point. Because as mentioned earlier, to know what the interest rates in the bond market will do in the short run is near impossible. We have to look at the long historical track record and develop an allocation system that actually lets us sleep well at night. Alright, now that you've decided your simple allocation, let me wrap up this video by talking to you about some specific accounts to hold your cash and bonds in. And understand this is just my personal opinion on what I think is best. So if you find something better, don't hesitate to use that. When it comes to the best place to hold your cash, I say high yield savings accounts. Right now, many are offering around 4 to 4.5% APY. Look for accounts with no monthly fees, no minimum balance requirements, and FDIC insurance. These days, there are many solid online banks that consistently offer competitive rates. For your bond allocation, keep it simple with a total bond market index fund. These funds give you exposure to thousands of bonds, government, corporate, mortgage-backed securities, all in one fund with ultra-low fees. Whether you go with Vanguard's VBTLX, Fidelity's FXNAX, or Schwab's SWAGX, they're all essentially the same thing with expense ratios under 0.05%. Pick based on which brokerage you already use. And please don't overthink this part. The slight interest rate difference between different high-yield savings accounts and the expense ratios between different bonds is not going to make or break your wealth. What matters is having a system that you understand and you stick with. And one more thing. Once you decided on your allocation and your account, resist the urge to constantly tinker with it. Don't overreact to news about the interest rate changes or market in general. You have to recognize that the financial media makes money by keeping you anxious and engaged. Every day there's new headlines about why you should panic about bonds, or why cash is trash, or why everything is about to crash. Ultimately, the decision you're making about cash versus bonds is not going to make or break your wealth. Whether you earn 2.5% or 4.5% in your cash for the next 2 years will have virtually zero impact on your long-term financial success. What will impact it is having a system you understand and can stick with regardless of what talking heads on TV are saying. Thank you guys for watching the theme of cash. If you want to learn some of the best options to keep your cash in, please check out my video here. Until next time, all the best.